All right, so thank you everybody for attending our How to Retire as an Entrepreneur class. Now, at first, I titled it How to Retire as a Real Estate Agent, but this doesn't just apply to real estate agent. It applies to anybody that's an entrepreneur or self-employed, so that's why I changed the name, because a lot of people are thinking, oh, they have to be a real estate agent to come to this class or to come to this webinar, okay? So you don't have to be a real estate agent. You just have to be an entrepreneur or want to be an entrepreneur, okay? And hopefully the information here can help you guys kind of get an idea of what you want to plan as far as your retirement goes, because as entrepreneurs, we all go and think about how to make money, how to increase our business. Okay, how do we save money? How do we prepare for the long run? Because ultimately that's the reason why we do what we do, is because we want to someday be able to retire, okay? And if you really think about it, entrepreneurs don't really actually ever retire. Retirement is actually just for the regular working person. They go to work 9 to 5 every day, and then they clock out at the end of the day, and they retire when they turn 65 or whatever the age is. But as an entrepreneur, we don't want to retire in that sense, okay? So when I say that you want to plan for your retirement, it's planning for your ability to do whatever you want on your own terms, okay? So say, for example, for me right now, right, a lot of people don't know, but I'm retired. But I actually work more now that I'm retired than when I was working a regular W-2 job, okay? But the only difference is that if I didn't want to work, I wouldn't have to, okay? And I could just live off all of my savings and retirement, or all of my investments that I have, okay? So I choose to work, okay, even though I am technically retired, okay? But what we want to do is I want to get into the presentation now, okay? So I prepared a little PowerPoint for us, and I'm just going to use it as a guide. So again, if you guys have questions, if you guys want to go off topic, or if you guys want to go deeper into any topic, go ahead and put it in that chat box, and I will answer it as it comes up, or I'll try to answer. Share the screen right now. Give me 1 second here. Okay, hopefully it works. All right, so what you guys should be seeing on the screen is the PowerPoint presentation, okay? So again, this is about how to retire as an entrepreneur. So if you're here for anything else, then you're in the wrong spot, okay? And can somebody just quickly put in the chat box, type yes if you can see the PowerPoint, so that way I know that you guys are seeing the PowerPoint. All right, awesome, cool. Thank you very much. Okay, so again, if you guys don't know who I am, my name is David Yang. I am a real estate broker, a real estate investor, private lender, father of 2, and a motorcycle rider. Okay, so that's a little bit about me, all right? Now today what I'm going to talk to you guys about is about how to set up your retirement, but one disclaimer is that this is not financial advice, okay? So this is just information for you guys to take and possibly think about how you guys want to set yourself up for retirement, okay? So again, I'm not a financial advisor, I'm not a CPA, I'm not a tax accountant or anything like that. I am a real estate agent, but I'm not your real estate agent, so you're out of luck there also, okay? Unless you want to be my client, then I'll give you some real estate advice. But if you have any questions about your specific situation, or you want advice on your specific situation, consult a qualified licensed professional, okay? And well, I will not tell you guys how old I am, okay? Because I'm pretty old. I don't look it, but I'm pretty old, okay? All right, so going on to the next slide here. This is my retirement portfolio, okay? So I call it the asset allocation. This is where all of my, how I break up all of where my investments go, okay? We can see here that a large portion of my investments are in real estate, about 72% of my overall portfolio. 5% are in stocks, okay? And we'll get into each of these sections as well, all right? And then 19% is in cash, 3% are in notes, and 1% is in crypto, okay? So what I'm going to do is I'm going to take you guys through each of these sections and kind of explain a little bit about them. And then one thing I also want you guys to understand is that this is just from my experience, okay? Everybody has their own way and have their own ability to set up their retirement portfolio however they want, okay? We call them financial vehicles. You can set up any financial vehicle in your retirement portfolio. This is just what I choose to do, so this is kind of what I'm going to be talking about, okay? So first off, let's talk about what you need to do before you even think about retirement or investing, okay? So before you even think about investing, you want to build an emergency fund, all right? Because it doesn't make any sense for you to go out there to invest and put money into retirement accounts if there's an emergency come up and you have to, liquidate those accounts to pay for that emergency. It doesn't make sense, okay? So what you want to do is you want to have at least a 3 to 6 month reserve saved up in physical cash, okay? And what I mean by physical cash is, I mean physical cash, like green cash in your hands, okay? Personally, I don't believe in putting the 3 to 6 month emergency fund in the bank, okay? Because you want to have it with you, okay? Either at your house, under your mattress, buried in the yard, something like that. That's what I would suggest, okay? And there's a reason behind that. People are like, well, that's not smart. What if your house burns down? What if, you lose your money, somebody robs you? Yes, that sucks. But, again, we have to think about let's see, Marsha can't hear me. Can you hear me now, Marsha? You might want to turn up your volume, okay? But the reason why you want to have it in physical cash is because what if, everything goes to, crap, Think about what's going on right now. What if Russia decides to invade the United States? Okay, what would happen? What happened when they invaded Ukraine? The banks shut down, right? So nobody could go get their money. So that's when it would have been good to have your cash with you, okay? So you want to save up about 3 to 6 months in physical cash. So that's money that you can use right away for any emergencies, okay? Now the next thing you want to do is you want to have, this is in case your bank accounts, you can't access your bank accounts, all right? The next thing you want to do is you want to have 1 to 2 years saved up in high interest saving accounts or other liquid assets, all right? Oops, sorry. And the reason for that is because market crashes, they generally last around 1 to 2 years on average. So when we go through a market recession or a market crash, generally that's how long it's going to take before the market starts to rebound, okay? So you want to have 1 to 2 years in a high interest savings account, so that way you can make it through the market crash, or at least that way you have some money saved up that you can use to purchase stocks or anything like that while they're on sale during the market crash, okay? So you don't want to worry about inflation with this money, okay? Because everybody thinks like, oh, if I have all this money, just sitting around in cash, wouldn't I be worried about it getting eaten away by inflation? Well, no, because this is your emergency fund, okay? This is not your investment fund. This is your emergency fund, all right? And, I'm pretty sure Elon Musk or Bill Gates is not in this webinar with us where, for their emergency fund, it might be in the billions of dollars. So, yes, they will worry about inflation. But for us that are just getting started out that, don't have a lot of money, our 3 to 6 months physical cash reserve could just be, $10,000. Maybe 1 year could be like $50,000 to $60,000, So it's not a lot of money. So I wouldn't worry too much about inflation with your emergency fund, okay? Now continuing on with cash, all right? it should be held in liquid assets. All right. So now I'm not talking about the emergency fund anymore. I'm talking about the cash that you have. Okay. So it should be held in liquid assets. That's physical cash, checkings and savings accounts, and then other currencies as well. Okay. So what I mean by other currencies is, there's other types of money out there. There's the Canadian dollar, there's the British pound, there's the Australian dollars. It's good to diversify your cash, so that way, let's just say if the U.S. dollar tanks, and it's not worth anything anymore, hopefully these other currencies will still have some value to them, which if the U.S. dollar crashes, then all of them are going to be pretty scary as well. But at least if you're diversified, then, that spreads your risk a little bit. So think about investing in other types of currencies as well, okay? All right, so how much should you have, okay? So you should not be holding cash beyond your emergency fund unless you have a specific reason for it, all right? Now, a lot of people are like, hey, well, what about Warren Buffett, right? Warren Buffett, he holds about, I would say, close to $50 to $100 billion in cash, right? But he's not holding it just to hold it, all right? He's holding it because he's waiting for the right opportunity to purchase a business, okay, or purchase shares of a business, because as he knows, as soon as he deploys that capital, he's going to be able to recoup what he lost in the inflation by making that smart purchase, all right? So he has a purpose for the cash. That's why he's holding on to large amounts of cash, okay? Now, if you're thinking about just holding the cash for just, saving, because, that's what our parents taught us, that's what schools taught us, then you are going to lose it to inflation, especially if you're holding a lot of cash, all right? Now, when I say a lot of cash, I'm thinking more than $200,000. If you're holding $100,000 and less in cash, I wouldn't even worry about inflation, all right? Because inflation is at 8%. So if you're holding, less than $100,000, I wouldn't even worry about it. If you're holding more than 100 to, if you're holding like 150, 200 and up, yes, inflation is very, very bad. So you want to deploy that capital or have a reason to hold it, okay? Now, we have somebody that said, what about gold? So gold, I don't really consider gold a liquid asset, all right? Because gold is more of a store of value, meaning that you put money into it, and you have to, you have to sell it, all right? You have to sell it before you can get money from it, okay? Now, you can use it as a currency, but it's very hard. Not a lot of people, you can't go to the gas station and give them a bar of gold for gas, okay? So that's why gold is not really a good form of liquid asset, okay? It's more of a store of value, okay? But that's a good question. All right, so the next thing is real estate, all right? And I'm going to be moving kind of quick through these. So again, if you have questions, go ahead and put them up there. I'm going to try to answer as many as we can, okay? So real estate. How do we use real estate as a retirement tool, okay? Because we buy it and then we sell it, right? That's what it is, right? But we have to think about it more in terms of the investment, okay? So think about appreciation and debt pay down. When you purchase a property, generally it's going to increase in value over time, okay? Now, in the short run, it might go up, it might go down, but in the long run, it generally goes up. So that's appreciation, okay? And then while it's going up, we're paying it down, okay? Because this is assuming you're going to get a loan, which, most people are going to get a loan. So you have the value going up and the debt coming down, okay? And that's going to bring us to our next point, is you can access tax-free money by borrowing against your real estate or borrowing against your asset, okay? So that's it. That's the secret to how the rich are rich, okay? They borrow against their assets, all right? So again, I think I made this comment at one of my other trainings, but, people are like, why don't the rich pay more in taxes? And how are the rich, staying so rich is because they don't think about assets. They don't think about real estate like we do, okay? So again, what I said earlier is we think about real estate is we buy it and we sell it and we get the money and then we can go spend it however we want. But really what it is you want to hold real estate, okay? You want to hold it for long term. So what you're doing is you're creating what's called generational wealth, okay? And what I mean by that is you buy it, you hold it, you die, you pass it on to your kids, they hold it, they die, they pass it on to their children. That's the type of asset or investment vehicle that real estate can be, okay? Now, a lot of people are asking me, okay, so how does this relate to retirement, right? So if I die, I can't use it, so it doesn't help me out. How do I access the money that's in there, right? Well, we borrow against it. You can refinance to take out the money, okay? So an example of this, because we want a real life example, how does this apply to you, or how can you apply this in your life, right? I'm not going to take retirement. I'm going to take college savings as an example, all right? So when my children were born, what I did was I went out and I bought real estate. Okay, I bought duplexes and other type of properties, right? Bought one for each, okay? So when they turn 18 and they want to go to college, all right, the debt pay down would have been a lot, and the appreciation would have gone up a lot. So there would be a lot of equity in that property. And what I could do is I can refinance that money out to pay for their college, okay? And at the same time, I still hold the property, and the tenants are still paying the mortgage, okay? So technically they're paying for my kids' college, okay? And I still get all the tax benefits of holding it, all right? And then once it gets paid off, then I'll have a free and clear property that I can do it over and over again. And then once I die or whenever I want to, I can transfer that property to my children, okay? So again, that's using college savings as an example, but you can do that. You can replace that with your retirement, okay? So buy a property, hold it until you retire, and then refinance to get the money out, and then keep having your tenants pay, and that'll be your retirement right there, okay? So my ask about how does real estate, how about shares, does real estate have shares to buy, okay? So with shares in real estate, you're generally talking about like corporations, okay? So say example, if you're setting up like an LLC to do like a syndication, all right? That's going to be on the scope of what we're talking about here. But in a syndication, they're going to sell shares of their company, which owns the real estate, all right? Now, you can do that as well, but it's a little harder because you don't have full control of the property, so you won't be able to dictate when you're going to refinance or sell the property. So that's going to be a little bit harder, but that is a good way to invest your money as well. So if you're really into that, I would say Google or look into real estate syndications. Okay. So we are going to move on here, and with real estate again, the best real estate that works with this strategy is buy and hold rental investment properties, okay? So for all you house flippers, for all you wholesalers, I'm sorry, this doesn't work so well because, again, you're not holding that real estate. So, those types of real estate investments are considered more active income, okay? So those are your jobs. You're a flipper. You're a wholesaler, okay? Rental real estate is more passive, okay? And this is where it comes into where you have a lot more options to use it as a retirement tool with your passive income, okay? All right, so let's move on. So let's talk about stocks, okay? So as you saw earlier, stocks was part of my portfolio, all right? But there is a lot that we have to talk about stocks, okay? So how do we incorporate stocks into our portfolio, all right? So we can do that as individual stocks. All right, so you can go out to any brokerage, any stock brokerage or website that sells stocks, and you can purchase an individual stock. You can go and buy a stock of Apple or Tesla or whatever you want, okay? Now, one thing you have to understand is that individual stocks are going to be pretty risky, okay, unless you do a lot of research. And even if you do a lot of research, it's mostly going to be based on luck, okay? Now, when I talk about stocks, okay, I'm talking about the stocks that you and me, all of us regular people look at, okay? And if you think about the stock market in general and stocks, think about it as a game, right? So if you're playing the game, okay, and you're making money doing stocks, that's great. But who is actually the real winner in the game? It's not the people playing the game. It's the people that created the game, okay? So another analogy of this is think about the lottery, all right? So they have the lottery out there. You can go buy a ticket for $2. If you win the lottery, great, okay? But ultimately, who is the winner, or who is the one that created the game of the lottery? It's the government, okay? We're just playing on the peasant level. The government is playing on, you know, the ultimate level. So in stocks, it's the same way. So we are all buying individual stocks, okay? But the ultimate investor in the stock is the person that created the stock, the businesses, all right? So we have no control over the stocks. That's why it mostly comes down to luck, all right? Unless you are going to be purchasing a very big portion of the company or a lot of shares, then you really have no say in the individual stocks. You can't really control it, okay? Now, another way that we can get into stocks is using tax advantage accounts, okay? So the first one we're going to talk about is the traditional IRA and the Roth IRA, okay? I don't want to go too far in depth into these. You can just Google them, okay? I want to get to where how do we incorporate them and use them as a strategy in our retirement, all right? But I just want to give you guys a little bit of background into what they are. So the traditional IRA, it gives you a tax deduction when you put money in, but you're taxed when you take money out, okay? So you just have to, you know, decide if that's going to be good for you, okay? Now the other one is the Roth IRA, which gives you no tax deduction, but you're not taxed when you take it out, all right? The reason for that is because you're using after-tax dollars to invest in your Roth, okay? And contribution limits right now are about $6,000, and if you're over 50, the contributions bump up to about $7,000, okay? Another tax advantage account that most people might have, especially if you work a regular job, is a 401k from your employer, okay? Now, the one thing with 401ks that I tell everybody is if your employer offers a match, take it. It's free money. I don't know why people don't take it, okay? Like I have family members that I talk to, and I ask them, you know, do you have a 401k match? They say yes. I'm like, are you contributing the max that you can to get the full thing? They say no, because they want to use the money. It makes no sense. That's free money they're giving you, okay? So max it out. Max out the 401k, okay? And the difference between the IRAs and 401ks is IRAs are generally, if you don't have a 401k, you get an IRA, all right? But you can have a 401k and an IRA as well. Again, you know, you can just Google it and it'll kind of tell you what the requirements are to get those, all right? And the third one, this one I really, really like, is the, I actually have it spelled back, the letter spelled backwards, but it's supposed to be HSA, not HAS, okay? What that is a health savings account, all right? These are great because you get tax deduction when you contribute the money, okay? It grows tax-free, and then when you pay for qualified medical expenses, that's tax-free as well, okay? And you can use it to invest just like IRAs and 401ks, okay? So what does all this have to do? How does this go into your retirement plan, right? So there's many types of retirement accounts out there, and you want to do your homework. But how we tie this all together, okay, is each type of tax advantage account, all right, you can purchase different types of retirement vehicles, okay? You can purchase individual stocks, all right? You can purchase mutual funds. You can purchase ETFs or exchange-traded funds, okay? Sometimes if you have self-directed accounts, meaning that you don't have them through your work, that you control how to invest it, you can invest it into real estate, you can invest it into business, okay? So a lot of people, what they do is they will go out, well, not a lot of people, but some really smart business owners, what they'll go out is they'll go buy stocks of companies or invest in companies that are small and they're growing, and when they grow inside of their tax advantage account, so that way all the money that they make from owning that business, it's essentially tax-free, okay? So that's a strategy that a lot of rich people use to get around paying taxes, okay? But what you want to do, okay, because what we want to do is we want to limit our risk in the stock market while taking advantage of all of these different tax advantage accounts, okay? And how we do that, and how I do that, is I do what's called dollar cost averaging, okay, or DCA. What that means is that instead of going out and searching for the stock that I want and then buying it at this price and then buying the next one at the next price, what I do is every month I automatically set aside a certain amount of money that I want to put into my either IRA, HSA, or whatever I want to put it into, okay? So let's just say if I want to invest $500 a month into my IRA, that's what I would do. No matter if the market's up, if the market's down, I'm putting $500 and I'm dollar cost averaging. The reason why that helps is because you don't have to time the market, okay? Dollar cost averaging, if the value of the item that you're purchasing goes down, then you actually just purchase more of it, all right? And if the value of the item that you're purchasing goes up, you're purchasing less of it, okay? So what that does is that you're buying more when it's low and you're buying less when it's high, so that way over time it would just be going up, okay? So we have a question here. Wouldn't putting money in a standard IRA and HSA help lower your total income for the year, okay? So yes, that could possibly lower your total income because you can deduct those, all right? So talk to your tax accountant on which deductions you can take, but generally, yes, if you're talking about traditional IRA and HSA, you should be able to deduct those, but again, check with your tax person, okay? We have another question here. HSA, do you need to have a certain kind of medical to qualify for this type of account? Yes, generally what you're going to need to have, the type of insurance plan that you're going to need to have is you're going to need to have what's called a high deductible medical insurance plan, okay? Just Google HSA requirements and they'll tell you, okay? So you need to have that to have an HSA, all right? So let's tie everything in together, okay? Dollar cost averaging, and then what should we be investing in? Which stocks, right? That's what we want to know. Which stocks should we invest in, right? I'm going to tell you exactly right now which stocks you should be investing in. Are you guys ready? Do you guys want me to tell you what it is? Okay. You should be investing in every stock, okay? And what I mean by that is you should be investing in the total stock market, all right, if you want to reduce your risk, all right? ETFs, exactly, Lou, exchange traded funds. So very briefly, I'm going to explain what an ETF is because some people might not know what it is. Just think of it as a basket, right? And you can put any kind of stock into this basket that you want. You can put multiple stocks in there, okay? So say, example, an technology ETF holds technology companies, okay? Tesla, Microsoft, Apple, all those technology companies in there. And if you're dollar cost averaging and you put $500, your $500 is going to go to buy a little portion of each of those businesses in that ETF, okay? So how you put it all together is you set up your tax advantage account, okay? You dollar cost average into there, and then you buy an exchange traded fund that holds as many businesses as you like. So there's exchange traded funds for every kind of sector. Generally, what I buy is I buy the S&P 500 ETFs, okay, and I buy the overall market ETF. So I buy like a Vanguard ETF that holds all of the businesses in there. Now, another great thing about the ETFs is that it reduces your risk, because if one business inside there goes bad and it doesn't meet the criteria of that ETF anymore, it's going to get dropped and a new business is going to get put in there. Okay, so your money is spread out across a few businesses, if not hundreds of businesses. Okay, now if you compare that to just buying an individual stock, if your individual stock goes down, then that's it. So again, like I said, if you have $500 and you're buying an ETF and one business goes down, then you're still good. You still have the other businesses to hedge you against your loss there. But if you take that $500 and you buy one stock and they go down to zero, then that's it. You're done. Okay. So set up your tax advantage accounts. Okay, dollar cost average, and get ETFs. All right, that's going to be generally the safest way to do it. Okay, and that's what we're talking about here. Is we want to be safe because we earned this money already. We don't want to lose it. Okay, and the last thing about stocks is they are different than real estate. Okay, because you think about it, real estate, if the value of the property goes to zero, okay, you still have the structure there. The wood is still there. The land is still there. So all you have to do is you just have to wait, and the value will go back up. With stocks, if the stock goes down to zero and the company goes out of business, that stock ain't ever going back up. Okay, so that's one thing, is we need to reduce our risks when we're talking about stocks, because again, we don't control it. We're playing the peasants game. Okay, we're not playing the creators game. All right, so that's stocks. Okay. All right, next thing is we're going to talk about notes. Okay, and specifically promissory notes. So that's money that people owe you. Okay, so I have notes in my portfolio because I don't want to owe money to other people. I want people to owe money to me. Okay, so you can have notes for a lot of different things. All right, so they can be for real estate. They can be car notes. If you loan money to somebody to buy a car, okay. You can do personal loan notes. You can loan money for personal stuff. So essentially, you want to be a bank, okay? Because if you think about it, who are the ultimate investors, okay? Who controls our whole economy? It's the banks, okay? If you guys haven't read the book yet, read the book called The Creature from Jekyll Island. I forgot who the author is, but it's The Creature from Jekyll Island. That's the name of the book. And it's kind of boring, but read it all the way through, and you'll understand who controls the economy and essentially who controls the world. Okay? So what you want to do is you want to be like them. You want to be a bank, okay? Legally be a bank, all right? So I generally prefer to do real estate notes because I want to make sure that it's tied to an asset, okay? And then Gang right here, he asks, how much interest do we normally charge? So it depends on the risk that you're taking with your money that you're lending out and the asset that you're lending it for, okay? So obviously if you are, if there's no asset, so if you're just doing like a personal loan, you want to charge a good amount of interest, okay? Because, you're taking on a lot of risk. If it's real estate, you might want to give a lower interest because it's a lot safer, okay? And if they don't pay you, you can take the real estate, okay, or the car or their business property or whatever it is. So you want it to be tied to something. Now, that's my suggestion, is make sure that it's tied to something, okay? And speaking about interest, you want to make sure that you are watching out for usury laws, okay? So what a usury law is that you don't want to be charging, 100% on something that's supposed to only be, normally charged, 10 to 15% for. Okay, so they have laws against that. And then also, you want to make sure that that you go over any licensing requirements. Okay, so if the state says you can only do 4 loans on houses, and you do 5, then you might need a license to do that. Okay. Now we have another question here saying that, would this be hard money lending? Yes, hard money lending could be one of it. If you want to be a hard money lender and lend your own money, you could do that. Okay. So that's generally what hard money lenders are. They're just private lenders. They could either be people or entities that lend out their own money. Okay. So that's what we do. Now with notes, you can actually go and buy notes directly from other lenders as well, okay? But it's going to be depending on the lender. So don't expect to walk into Wells Fargo and say, I want to buy one note from you, okay? The person at the counter might not even know what the heck you're talking about because they don't even know anything about notes as well, okay? You can buy notes, but again, you're going to have to, really dig deep to find lenders that will sell you notes, especially if you're buying, small notes or very, individual notes, okay? Generally, large institutions like, big banks and things like that, they sell notes in the bundles, okay? So they buy notes and they sell notes on what's called the secondary market, and those are in the, billions of dollars. So unless you're thinking of buying notes in the billions of dollars, you might have more luck trying to buy notes from individual people. So say example, a person gives a loan to another person to buy a house, maybe you can approach that person and say, hey, I'll buy that note from you and I'll collect the interest. Okay, so that's another way for you to get notes as well. All right. So that's what I do. I incorporate notes into my portfolio because, again, I want people paying me. Okay, I don't really want to be paying other people. Okay. Now let's move on to the next topic, which I think most people are going to be interested in, which is crypto. Okay. So this, if you're seeing the graph right here, this is actually my portfolio of crypto. Okay. I'm pretty new to the crypto game as well, so if you ask me some very hard questions, I might not be able to answer them, but I'm going to give you guys my perspective and my experience from my short time that I've been investing in crypto, okay, and my strategy and thought process of how to invest in crypto, all right? The first is don't get sucked into the hype, all right? And we all know what that is. We all heard of Dogecoin and Shiba Inu. As you can see right there, I have Shiba Inu as well, and I will tell you, I bought that on the hype. So I bought it when it was high and like right before it tanked. So I put like $1,000 in there. I didn't really care. I was just playing around with it. But now you can see it's down to like a little above $300. So again, don't buy the hype because that's the same thing as like with stocks. You're just flipping a coin to hope that it goes up. You don't control it. Okay. Again, think about what I told you about the lottery, about the stock game. Okay, crypto is the same way. Okay, when we're buying cryptocurrencies, we're playing on the peasant's level. Okay, who is the winner? Who is the creator? It's the people that created the coins. Okay, they are the winners. They're controlling the game because they created the game. Okay, but if we want to play in it, we need to have our strategies set in so that way we don't get exposed to so much risk. Okay, so don't buy the hype. Okay, I do have a few other small coins that I buy, but I don't really buy anymore anyways. So we have another question here. Also, what are your thoughts on yield farming or staking? Not too familiar with that. So those are just other things that you can do to get interest on your crypto. Okay, so essentially, those are where you're promising your crypto that you have for other people to lend out and to get interest, and then by their getting their interest, they're paying you a small portion of it. So that's kind of what you're referring to when you say yield farming or staking. You're just letting somebody else borrow your crypto, and they're paying you interest for that. Okay, so I tried that out as well, but right now I don't really suggest it too much, just for the fact that crypto is so new. There's not a lot of regulations around it. So a story is I invested in a company that did that, okay, and then it's a very well-known company as well, and they got, I'll just tell you, it's BlockFi, okay, it's called BlockFi. They are people interest on the money they put in there, and I put about $1,000. I didn't really care, if I lose that, that's fine. But the government came in and said, hey, you know, they can't do that, so they can't do that anymore. All right. So you want to be very careful with all these stakings and getting interest on your crypto and all that stuff, because there's not enough regulation to get out there and regulate all that stuff yet. So you don't want to have your money in there and then it gets caught up in all of these processes that, you know, could make it very risky for you to get your money back. Okay. So what I really use crypto for is I use it similar to like gold. Okay. So I don't hold any gold, but Bitcoin is being made out to be similar to gold. Okay, like a digital gold. It's a store of value. Okay, so it doesn't have the long track record like gold. It doesn't have the 1,000 years of being in existence like gold does, you know, but it's being used as a store of value. Okay, and the other one is Ethereum. That's a little newer too. So those are the two that I buy right now, is just Bitcoin and Ethereum. So what I do is I dollar cost average. Okay, I dollar cost average into Bitcoin and Ethereum every single day. So I buy about like $20 worth of Bitcoin and $20 worth of Ethereum every single day. So people ask me, why do I do that every day? Is because, you know, the fluctuation of the crypto market happens a lot faster than with stocks. Okay, so cryptos, they can, you know, 1 second be up 50% and the next second be down 1,000%. Okay, so that's why I want to capitalize on all of that fluctuation. That's the reason why I invest a little bit every day. Dollar cost averaging. Okay, I don't buy on emotion. So just because it go down doesn't mean I buy $100. I still keep it right at $20. Okay, so dollar cost average, and I don't get emotional. All right. What you want to do too is you want to stick with the coins that have a long track record. Okay, so again, I stick with Bitcoin and Ethereum because I don't think they're going to be going anywhere anytime soon. Even if the value goes down very low, they're here to stay. You know, they're not going anywhere, just for the fact that they're one of the first ones, right? Especially Bitcoin. Okay, Bitcoin is not going anywhere. At least, you know, I don't think it is. So that's the reason why I choose to invest in those. But again, you got to think about it. If we're comparing it to gold, all right? Somebody mentioned earlier, what about gold? Okay, so again, you can't. Right now, it's hard to go to the gas station and say, hey, I'll give you 0.0005 Bitcoin if you give me like 5 gallons of gas. Okay, so it's more of a store of value, and it's not really a form of liquid assets or cash. Okay, because the Bitcoin you still have to convert it to cash. Okay, and that costs money as well. All right. So this whole thing about Bitcoin, Ethereum, all these coins being used as currency, I don't really see it right away. You know, I don't think you can use it as currency right away because it has to be converted back into real currency before you can use it. Okay, and you have to use real currency to buy it. All right, so you know, can you use it as currency? Yeah, I mean, you can give somebody Bitcoin, they can do something for you. But in the mainstream right now, yeah, Bitcoin is more going to be a store of value than it is currency. Okay, so that's why I like to invest in it the way that I invest in stocks. Okay, now we have another question here. Do you borrow against your portfolio, and if so, what are the rates? If not, what other processes do you use? Okay, so I'm assuming that you're talking about the crypto portfolio. Okay. I don't borrow against my crypto portfolio just for the fact that it's so small, okay? And it's, again, like what I showed you guys earlier, it's only about 1% of my overall retirement portfolio, so it's very small, okay? Lenders, they want to make sure that you have a lot of value in your investment vehicle, whether that be in real estate, crypto, or whatever, before they lend to you. Now, you can find some companies that are specifically geared towards crypto that will lend you a portion of your crypto if you have it stored with them. But again, to really use it as a just go out there to any bank and say, hey, I have crypto, will you lend to me? No, I don't do that just because I don't have a lot of it. Okay, and again, the reason why I don't have a lot of it is because I just started, and I don't want to go all in on it because it's not proven yet. Okay, so even though I say Bitcoin is here to stay, it's not going anywhere. Bitcoin and crypto has not had its depression yet. Okay, so gold has had its depression. The dollar has had its depression. Stocks has had its depression. Crypto has not even had one. Okay, they've had major swings, but they have not had one depression where it came close to wiping everything out. Okay, once it has that and it's proven that it can survive that, I will probably increase my holdings to more. But right now, my target is roughly around 5% of my portfolio. So right now I'm at 1, so I have a long ways to go. But I'm sticking to around 5% of my overall retirement portfolio to around 5%. That's what I'm going to be allocating to the crypto portion. Okay? All right. So the next thing is we want to just keep track. Okay? So all of the stuff that we talked about, all those strategies and you know, what's the best thing to invest in and all that stuff doesn't matter if we don't track it, okay? Because if you don't track it, one, you're not going to know, okay? And two, this means that it's not important to you, okay? If it's not important to you, you don't track it. Like your kids, right? If you have kids and they're important to you, you track wherever they are, right? So why not your money? Why not your retirement portfolio? Okay. Now, if you guys want this tracker, I have it. I can send it to you guys. Just Facebook message me your email address if you guys are on Facebook, okay? Or you guys can send a message to me. I'll have my contact information here in a little bit. Just send it to me, and I'll email a copy of this to you, and you can just fill it out. You can track it yourself. But yeah, it's very simple, okay? I think at the beginning of the week, I sent out a little link about, you know, how to calculate net worth and what assets are and what liabilities are. It's very, very simple, okay? So on one side, you just list all of your assets. That's everything, your house, your cars, your cash, your investments, your retirement accounts, your gold, anything like that. You put it on your asset side, okay? Now, I know some people are like, well, you know, my rich dad, you know, Robert Kiyosaki, he said that my house is not an asset. Well, yeah, it's not an asset in his terms, but in this, you want to list it as an asset, okay, because it's appreciating in value, so list it as an asset, okay? And then you put everything on your liability side. Those are loans or anything you owe people, personal loans, those kind of things you put on your liability, okay? And then it's very simple. You just take all your assets and you subtract your liabilities, and that comes up with your net worth, all right? So hopefully when you do that, your net worth is positive, okay? You don't want it to be negative. You want it to be positive, all right? So assets, that's what the rich go after, buy assets. As you can see, this is mine, okay? So my asset column is really big. My liability column is, you know, probably like half that, okay? Now, again, everybody is different, all right? My liabilities probably equal to like 3 to 4 people's liabilities, okay? But don't worry about that. Everybody is different. The main thing you need to do is just start tracking. I track mine about every month. I just go through and just see where I'm at and just checking on my financial health, okay? And then again, on the left-hand side there, it shows me my asset allocation, so I can pinpoint exactly, you know, how much of my portfolio is being allocated to real estate, stocks, cash, or whatever else that I want to invest in, okay? All right, so I want to thank all of you guys for coming today, okay? We're about that time right now. We have about 10 minutes left, but this is my contact information. Again, David Yang, this is my email and my phone number, okay? If you guys have any other questions, you guys can go ahead and put in the chat box, and I will try to answer them for you. If not, hey, I want to thank you guys all for coming out. And again, I want to say, you know, just by you guys being here, you guys are taking the first step in controlling your finances, and that's what really matters, okay? Because nobody else is going to do this for you. Nobody else is going to keep track of your finances. Maybe the IRS, because, you know, they want you to pay your taxes, but other than that, then yeah, it's up to you to really track your finances and get everything in order so that way you can reach financial freedom. And we went through everything really fast, so if you have questions on anything individually, you can always reach out to me. But other than that, then yes, thank you, and have a great rest of the night.